studying your last two. I swim med when turned in. The staring down to mute. And can learn the pole that sunk he died.
Up to this point, we focused on calculating the capital dividend account, filing the election, and ensuring that the dividend amount is properly supported. But there's another critical aspect of capital dividend planning that is often overlooked: timing. A capital dividend is not a single event. Instead, it is a sequence of actions that must occur in the proper order and within the required filing deadlines. This slide provides a high-level view of the complete capital dividend timeline. Let's walk through it step by step. The process begins with the board resolution. This is the declaration date. The directors formally approve and declare the capital dividend. Without this corporate authorization, the dividend does not legally exist. Next comes Form T2054. This is the capital dividend election. The corporation prepares the election that tells CRA the dividend is intended to receive capital dividend treatment. This is one of the most important compliance documents in the entire process. After that, we establish the record date. The corporation reviews its share register and determines who the shareholders of record are. These are the individuals or entities that will be entitled to receive the dividend. Then we reach the payment date. This is when the corporation actually transfers the funds to the shareholders who are entitled to receive the dividend. At this stage, the cash leaves the corporation and the capital dividend is distributed. The process doesn't end there. The corporation must also maintain proper reporting and documentation. This includes Schedule 89, which helps summarize and support the corporation's CDA activity. The information becomes part of the corporation's broader tax compliance records. Finally, CRA may review the election, supporting calculations, and related documentation if questions arise in the future. This is why record retention is so important. Notice the reminder on the right side of the slide. Timing matters. Good practitioners don't simply calculate the CD balance and stop there. They plan ahead. They monitor deadlines. They coordinate the declaration date, election filing, record date, payment date, and reporting obligations. The workflow shown at the bottom of the slide summarizes the entire process. First, calculate the available CDA. Second, declare the dividend. Third, prepare and file the election. Fourth, determine the eligible shareholders. Fifth, pay the dividend. Sixth, complete the required reporting. And finally, maintain the records needed to support everything that was done. A common mistake is to think capital dividend planning is only about tax calculations. In reality, compliance and timing are just as important. A perfectly calculated CDA balance can still lead to problems if filing requirements are missed or documentation is incomplete. The key principle from this slide is simple. Good capital dividend planning is as much about timing as it is about tax calculations. The most successful practitioners manage both. In the next slide, we'll focus specifically on the filing deadline for Form T2054 and see what can happen when the election is filed late. Now that we've seen the overall capital dividend timeline, let's focus on one of the most important compliance requirements in the entire process: the filing deadline for Form T2054. Remember, Form T2054 is the election that tells CRA a dividend is intended to be treated as a capital dividend. Without this election, the dividend does not receive capital dividend treatment, and timing matters. Let's follow the sequence shown on this slide. The process begins when the corporation pays a capital dividend to its eligible shareholders. This is the payment date. The funds are distributed, and the corporation has now completed the actual dividend payment. However, the compliance process is not finished. The corporation must also ensure that Form T2054 is filed within the required deadline. This is where many problems arise. The election cannot simply be filed whenever it is convenient. CRA requires the election to be submitted within the prescribed filing period. The calendar in the center of the slide highlights this critical deadline. Think of this date as the finish line for the election process. Missing it can create significant complications. Now let's look at the two possible outcomes. The first path is the ideal situation. The corporation files Form T2054 on time. The election is valid. The capital dividend treatment is preserved, and the shareholders receive the intended tax-free benefit. Everything works exactly as planned. The second path is much less desirable. The corporation misses the filing deadline. Form T2054 is filed late. As a result, the election may be treated as a late election. This can trigger additional administrative requirements, possible penalties, and extra costs. What could have been a straightforward compliance process suddenly becomes more complicated. That's why the hourglass at the bottom of the slide carries an important message. Time is critical. A corporation can have a perfectly calculated CD balance. It can prepare the correct election amount. It can pay the dividend to the correct shareholders. But if the filing deadline is missed, unnecessary compliance issues can still arise. Experienced practitioners understand this risk. That's why they typically prepare the election paperwork before, or at the same time as, the dividend payment. They do not wait until weeks or months later to think about the election. Instead, they treat the election and the dividend payment as part of a single coordinated process. A useful way to think about it is this: the dividend payment and the election filing should travel together. One should not be completed without planning for the other. The key takeaway from this slide is simple. Form T2054 must be filed within the required deadline to preserve the intended capital dividend treatment. Late filings can lead to penalties, administrative complications, and additional costs. That's why one of the most important practitioner habits is to prepare and file the election on time, not after the deadline has already passed. In the next slide, we'll examine late elections in more detail and discuss the penalties, risks, and best practices that every tax practitioner should understand. We've now seen how important it is to file Form T2054 on time. But what happens if the deadline is missed? That's the focus of this slide. A late election does not automatically mean disaster, but it can create additional costs, administrative complications, and unnecessary risk. Let's start with the left side of the slide. This shows the outcome of good planning. The corporation plans ahead. It calculates its CDA balance. It prepares Form T2054 on time. Schedule 89 is filed with the corporate tax return. Supporting documentation is maintained, and all deadlines are met. The result is exactly what every practitioner wants. No penalties, no surprises, and the intended capital dividend treatment is preserved. Now compare that to the right side of the slide. This is the result of poor planning. The filing deadline is missed. Form T2054 is filed late. The election becomes a late election, and the corporation may face penalties, interest charges, and additional administrative work. Instead of a smooth compliance process, management and advisors now have to spend time correcting problems that could have been avoided. At the center of the slide is the most important warning. Late elections can trigger several consequences. These may include penalties, interest charges, administrative issues with CRA, and, in some cases, a reduction in the overall tax efficiency of the transaction. The exact outcome will depend on the circumstances, but the common theme is clear. Late filing creates risk. The timeline at the bottom illustrates how these situations often develop. A dividend is declared and paid. The filing deadline is overlooked. The corporation realizes the election was not submitted on time. A late election request may then be filed. CRA reviews the request, and depending on the facts, penalties or other consequences may apply. Notice the important note below the timeline. CRA may accept a late election in certain situations. However, acceptance is not guaranteed. Even when relief is available, penalties and interest may still apply. That's why experienced practitioners never treat late election relief as part of their normal planning strategy. Instead, they view it as an emergency remedy when something has gone wrong. The checklist on the right side summarizes several best practices. Verify the CDA balance before declaring the dividend. Prepare Form T2054 in advance. Track and confirm filing deadlines. Submit the election within the required time period. Include Schedule 89 where appropriate. Maintain supporting documentation. And keep records long enough to support future reviews or audits. If you look at the advisors shown in the illustration, you'll notice that successful compliance is usually the result of organization rather than last-minute action. Calendars, checklists, records, and planning systems are often just as important as technical tax knowledge. The key takeaway from this slide is simple: file on time. Late election relief should be viewed as a backup plan, not the primary plan. The best way to avoid penalties, interest, and administrative complications is to prepare early, monitor deadlines carefully, and complete all required filings before the due date arrives. In other words, the most effective capital dividend strategy is not just accurate tax planning, it's disciplined compliance planning as well.